Alright, so welcome to our weekly market wrap up. Today we're gonna have a look at the most important market events from this week, their impacts moving forward, and most importantly, how I'm positioning myself and how I'm interpreting this data. So, as always, if you enjoy these conferences, please make sure to spread the word and let others know what I do here because your support never goes unnoticed. And with that being said, let's jump into the macro data from this week. So this week we had the ADP employment change, which came in at 37,000. Now this is pretty much the lowest point since 2023, as we can see here, and this suggests that the labor market might be weakening. And this is something quite important because I believe the labor market is one of the most important metrics right now to track to assess the health of the economy for the moment, and most importantly, how they could impact the monetary policies. Now, as I've discussed before, and as you all know, the monetary policies play a major impact in shaping the markets. So the reason why we want to pay attention to the labor data is because it has a major impact on these monetary policies. So the ADP employment change came in pretty low. Then we also had the jobless claims, which came in pretty high, as some people have lost jobs. And this pretty much marks the highest point since October of 2024. Now this of course is another indication that the labor market might be weakening. And also adding the non-farm payrolls, which came in pretty low at 139,000. This is a bit lower than April, but it is not that bad. But it could have been better. And of course, we had the unemployment rate, which came in at 4.2%. So as I mentioned earlier, I believe the current labor market is still resilient, right? It is still healthy. It is still strong. But if it starts weakening, like we've seen this month, with the ADP coming in low, with the jobless claims coming in pretty high, the non-farm payrolls also coming in a bit lower than expected, and if the unemployment rate also starts going up, that can be the sort of warning sign that the economy could roll over in the next couple of weeks and months. Now, there are a lot of uncertainties around monetary policies for the moment. Personally, I have made this case as clear as possible. I have always been under the impression that as long as the monetary policies remain stable for longer, and as long as we have interest rates still at the same levels, the markets are going to go up. Because what the markets want is certainty. What the markets want is stable monetary policies, a stable macroeconomic environment where they can grow. Because it all comes down to the risk appetite of investors, and how investors perceive the markets is how the markets perform. If investors are feeling uncertain, then the markets are going to drop. If the investors are feeling confident in the economy or the monetary policies or the broader macroeconomic environment, then the markets are going to go up. So for that reason, I think that the fact that we're seeing right now the first rate cut being priced in September is a positive indication. That has been my base case for a long period of time now. As you'll remember, back in early April when the markets were crashing, a lot of people have started to believe in the idea of an emergency rate cut to save the markets. So I want to break this down for all of you because I feel like there are a lot of I feel like there is a lot of noise out there, and I want to bring some clarity. I don't think that a change in monetary policies would actually be bullish for the markets. Think about the Fed announcing a rate cut tomorrow. A lot of people think that a rate cut would be bullish for the markets. I don't think so, because if the Fed would cut rates, okay, not tomorrow, but in their next FOMC meeting in 11 days, If the Fed would declare that, then it would raise a lot of questions. Why is the Fed intervening? Why is the Fed cutting rates? Why is the Fed not waiting any longer? And let me tell you this, an intervention from the Fed is suggesting that the current path that the economy is on right now isn't sustainable anymore. Therefore, the Fed needs to intervene. That's how all of this works. That's why the Fed adjusts their monetary policies, because the path that the economy is on isn't sustainable anymore. So they have to make a change. Now, another topic I want to cover is the Treasury debt buyback operation, which came in at $10 billion. So that was the pair amount accepted. Now that is the max pair amount that they were going to accept, $10 billion. And a lot of people have started to highlight this on X. And there is a lot of noise on this, that we're finally seeing debt buyback operations, and we're finally seeing, investors buying debt and investors buying bonds. $10 billion is nothing compared to the outstanding debt of the US. So we always want to take into consideration, what does $10 billion mean compared to $36 trillion, right? It is not that big of an amount. And the fact that I've seen so many reviews on this, so many, posts, first of all, tells me that sometimes X and media outlets aren't a reliable source of information, because in order to gain engagement, they have to present information in a way that is appealing, in a way that is engaging. So most of the times, the way that they present it is, is going into the territories of being dishonest, to say the least. So I don't think this is major news. The only reason why I wanted to highlight this is to underline the importance of tracking objective data, and the importance of always having a long-term strategy that you stick to, and not being influenced by constant short-term noise. And so we get to our next topic of the day, which is that Trump calls for a full 1% rate cut. First of all, I've seen a lot of people worrying about this. I've seen a lot of people debating on this. Could we see a rate cut? Could we not? Is Trump going to impact the Fed, and so forth? Trump cannot change the monetary policies of the Fed. That's the first thing. What really drives the monetary policies of the Fed is the bond market. So yields are still high, right? Yields are still strong in this range that they have been in over the last couple of years. It is pretty much still the same range, nothing to worry about, nothing to outline here, right? Nothing to highlight of major importance. Only that yields have been in the same range over the last couple of years, and that they have remained strong. Now, as long as yields remain in this range, as long as yields continue to remain strong, the Fed cannot possibly cut rates, because then they would simply go insolvent. So think of this. Think of it this way. They have to pay, okay, so the coupon rate isn't currently at 4.5%, which is the 10-year yield, but let's say the Fed needs to pay 4.5%. So whatever the yield on the Treasury is. And they reduce rates. They reduce their interest rates to 4.25% or 4%. Then they have to pay more than they earn. So that leads to insolvency. That's why the bond market always front runs and leads Fed's policies. That's a very reliable way through which we can predict the future monetary policies of the Fed. And this is also why I think that it is safe to say that the first rate cut will be in September, no matter what the noise is on the timeline. No matter how much people scream for a rate cut no matter how much Trump insists that we see another rate cut, as long as yields remain strong, then monetary policies will remain the same. So that's the first thing I want to highlight with all the noise on the timeline. The second part is around tariffs. Tariffs are re-emerging once again. So after we've seen what happened back in early April with all of those tariff fears, tariff headlines, and everyone worrying about the potential recession and the impacts that tariffs may have on the economy, a lot of people worried about a potential stagflation as tariffs lead to artificial higher prices, which, if the consumers is tapped out, consumers are no longer able to afford that particular product, therefore the demand for that product drops. So you have high inflation, you also have low economic growth because there is less consumption power, and that leads of course to an unstable labor market and pretty much the definition of what a stagflation means. That's what a lot of people have been worried about back in early April, and now tariff fears are re-emerging once again. And we'll talk in just a couple of minutes on why I think that tariff fears or all of this noise is currently in play for the markets, so make sure you stay tuned for that as well. But with these tariffs, personally, I don't see major news. Okay, there might be some tariffs, but as we've seen, no tariffs have been really implemented. So there were a lot of fears, especially when Trump announced 150% tariffs on China. Those were never going to come. If these tariffs would actually come, that would lead to riots. That would lead to, actual problems in the society, and Trump losing political support and so forth. So those are things that Trump doesn't want. And we must remember and we must remind ourselves that Trump is a businessman. So Trump thinks about himself. And implementing these tariffs is not good for himself. So not to say that they aren't good for the country, or they aren't good for the global trade, or that they aren't good for the economy. They aren't good for himself. So for that reason, I don't think that these tariffs will ever be truly implemented. I think they are being used as a weapon to negotiate, and that's my personal stance on what these tariffs mean. Now, another thing is imports have dropped, as we've seen in the latest macroeconomic data this week. Here we had the imports dropping by 20% in April, recording their largest ever monthly drop because, as we all remember, a couple of weeks ago we had all of those pre-tariff imports from companies who were trying to front run the tariffs, so to buy the raw materials and whatever they need at cheaper prices before tariffs hit. That's what led to a spike in imports a couple of weeks ago, and now we're seeing imports dropping this week in the latest macroeconomic data. Now, the reason why imports are important is that they have an impact on the GDP. And as we've seen back in April, when the GDP came in at minus 0.3%, while the consensus was at 0.3%. So instead of seeing a moderate growth, we've seen a moderate contraction. Now, at the time, I've explained that why I thought that happened, and it was mainly because of those pre-tariff imports. Whenever imports go up, the GDP goes down. And because we're seeing imports dropping, it will lead to a higher GDP. So that's my stance on imports. This is why I think that tracking imports is currently important. And I think that this moderate contraction we've seen right now, so it came in a couple of days ago at minus 0.2%, I believe that the next reading will be in positive territories, and instead of seeing a moderate contraction, we will see a moderate growth, as we should have seen from the beginning if there weren't for those tariffs and all those pre-tariff imports. So this is why we want to track imports. This is why we want to pay attention to the macroeconomic data. And of course, if we see a moderate growth instead of seeing a moderate contraction, that of course could lead to higher prices in the markets as well. So now I want to move on to the next topic, which is the latest Trump versus Elon debate. Now I'm sure many of you are familiar with it already. There are a lot of statements being made. I'm not going to get through all of them because I'm sure most of you have read them already. They are pretty interesting and pretty funny, to be honest. Now I don't believe in any conspiracy theories, but what we've seen objectively is that those debates and those headlines have been used by someone to liquidate retail investors out of the market. And this is just objective data. Once all of the headlines with the debate between Trump and Elon and all of those that scandal came out, we've seen this major liquidation in the markets. So close to $1 billion in less than 24 hours. And that is just massive liquidations and only underlines the importance of being in spot positions, not using leverage. This is all something I always emphasize, is not using leverage. Leverage destroys wealth. And if you haven't learned anything from James Wynn, which has round tripped close to 100 million in a matter of days, then it's just simply your problem. And at some point you're going to learn the hard way why you should not use leverage. I am against leverage. I believe that leverage destroys wealth. No matter how good of a trader you are, at some point you are going to lose a ton from leverage. And you have bigger volatility on the short term, so you make more and you also lose more once you make a wrong trade. But at the end of the day, do you truly outperform the market? That is the question. Have you truly outperformed if you simply held? And the reason most of the times is that no, you do not outperform simple holders. So the way I see trading, the way I see investing is that you can sell in key spots. You can sell in key places where you have many confluences that are in the same direction, that are pointing towards the same direction, and you can either buy or you can sell. And by the use of many confluences, you can determine whether the risk-reward perspective is in the favor of the buyer or in favor of the seller. That's how you can do trading. That's how you can de-risk or accumulate in key places. But by using leverage and always getting in and out of the market, you pretty much get trapped in the short-term noise. And that is something that I always try to avoid, especially as an investor, and something that you guys should avoid too. Getting trapped in the short-term noise and in the narratives and losing sight of the bigger picture. So now, a couple of days ago, right, when the markets were dropping, as I've highlighted earlier, because of the debates between Elon and Trump, we've had this pullback. And I've made this post. It's actually very interesting. I made this post to highlight what has been pretty much the average mentality on X from retail investors. At each of these consolidation ranges, the sentiment around this was that I'll wait for a pullback. And then the price just kept on going higher. And then once again, the price was starting to consolidate. People were believing that a pullback was next, so they were waiting for a pullback to buy. It never came. Then we had another impulse up. I'll wait for a pullback. Eventually, Bitcoin formed a new all-time high, and then it dropped. Now that we're seeing pretty much the first correction we've seen in over 2 months, since we bottomed out in early April, people are starting to highlight narratives. People are starting to become anxious once again. So now they're not buying on a pullback like they said they would, but they're having narratives. And I have made a post on this a couple of days ago. I usually don't share threads nowadays on X, especially this length. I usually make videos whenever I have something meaningful to say or whenever I want to share my detailed thesis. But I have figured that this is so important that I would make this thread. So I made this thread a couple of days ago with my brief explanation of the current market environment I'm seeing for Bitcoin and the S&P 500 moving forward. And it's pretty simple. I'm sure many of you are already familiar with it. It's actually pretty simple. Throughout January, February, and March, we've seen liquidity traps created by market makers, so they use retail as a counterparty. And I have shared a link to this here with a post I shared back in early April. This is how it has looked like. Basically, what we had at the time, and I covered this thesis many times then, is that we had this series of untapped lows that were developing on the low time frames, which eventually preceded this liquidation cascade. Now, the trigger for all of these liquidation cascades was a tariff announcement. So, a tariff headline or Trump implementing new tariffs and so forth. That was the trigger that has led to all of these liquidation cascades. And this has happened over and over again. The reason why I think these liquidation cascades have happened is because they give market makers the opportunity to buy and to accumulate. This is how I believe market makers have created for themselves an artificial counterparty, because if we look at these levels, for example, what they represent is pretty much liquidity levels stacked up on top of each other where traders set their stop losses. So for that reason, once they get swept, they trigger the stop losses of traders who took long positions. Now, a stop loss of a long position is equal with a forced sell order, which market makers fill with their purchasing, with their buying pressure, right? And this is how market makers have managed to accumulate all throughout February and March and early April. So this is the thesis I've covered at the time. And after that, we've seen extreme capitulation. So back in early April, we all remember the fears around recession and the fears around tariff headlines and so forth. So that was the phase where a lot of people have increased their cash positions in order to position themselves for lower prices. Then of course, the markets have bottomed, and then we started this reversal. But the way we reversed is far more interesting than the reversal itself. Because if you look, for example, at a chart, so let's look at Bitcoin, for example. The way we reversed is far more interesting. And this is something I highlighted in an earlier post I showed you. Pretty much we had these consolidation phases, right, that have preceded each of the moves up so far. So I covered this in the average mentality post I shared a couple of days ago. And this is very interesting because these periods do not let retailers entry at a pullback, right? So every time retail has waited for a pullback to entry lower, which never came, right? So instead of seeing this pullback, we've seen these consolidation phases, right? So pretty much how this has worked like is market makers have used retail as a counterparty to accumulate. Then they have shaken out everyone, made everyone increase their cash positions here to prepare themselves for a potential bear market or a potential recession. Like we'll remember how the mainstream sentiment was looking like at these levels. Then we reversed, and sideliners didn't get the chance to entry at any point until now. Now we're seeing the first pullback. So this is pretty much the first meaningful pullback Bitcoin has had in the past 2 months. And it is so Bitcoin is down 10% from its prior local high. This time around, this pullback came with a lot of narratives. And this is also something I highlighted in this post. This pullback came in with the narratives of a 2021 fractal with tariffs, Trump versus Elon. And do you know what that does? That makes retail still wait for lower. because the average mentality currently is that I'll wait a bit more because I want to make sure that we have bottomed out before I buy. This is the average mentality right now. And I believe that all of this fits up into a very nice big picture, which is of a disbelief rally. And how this would look like, we've seen something very similar happening back in October of 2024. So after we have reversed, we have seen pretty much what we're seeing right now, with Bitcoin gradually going up, but this being mainly a disbelief rally, where people didn't really think that that was the true reversal that would lead up to new all-time highs. At this point, a lot of people were saying, no, we're going lower, we're going to have a prolonged consolidation phase, and eventually we may have a breakout. But this will come only after we have this pullback. So a lot of people have also increased their cash positions at these levels. Then they didn't get the chance to buy because this was a disbelief rally, and then an emotional gap came. What we've seen back in November, when this major spike in price has led to this emotional gap. And what I also shared in this post is that it was a frenzy that made every sideliner FOMO back into the markets. But that wasn't random, and everything that led up to it wasn't random. We've had extreme fear, we've had capitulation, which was also followed by disbelief and bearish narratives. Then a spike in volatility and in the price came. And nothing was random about this. Nothing is random in the markets because it all comes down to liquidity and market makers having a counterparty to trade with. So you might not believe it, but it is just the reality. Market makers have big positions that they need to trade. So in order to trade them, they need a strong counterparty. So the only way they can have a counterparty is either by trading with someone else that is the same size of them. So another whale or another institutional investor, which almost never happens because most of the times they are on the same side. So they have to find another counterparty, which are retail investors. So they use fear at the bottom, they use bearish narratives, and remember how the bearish narratives and narratives in general work like. Narratives are only in correlation with the mainstream sentiment. So you're never going to see a media outlet or all of these big CT accounts that would be a contrarian. Why? Because they cannot farm engagement that way. They cannot gain clicks. And the way they make money is by gaining more clicks, by attracting more engagement. That's how they do it. So they need to be bearish at the bottom and then bullish at the top, because they have to talk about they have to interpret the data in such a way that is in correlation with the mainstream sentiment. That is how all of this works. So when we reach the bottom, each time there are extreme bearish narratives, extreme bearishness, that makes people capitulate. So a lot of retail investors look at the narratives, a lot of retail investors look at the fear and at the fundamentals and at the way those news are presented, so they make the decision to increase their cash positions. Then we have a transition. So you cannot durably shift from a state of fear to a state of euphoria directly. We need to have a transition. And this disbelief rally is exactly this transition, from a state of extreme fear to later on a state of extreme euphoria. This is the same phase I believe we're currently in right now. This phase of disbelief, where people don't really think that this is the true reversal. They make up all of these bearish narratives, especially when we reach key phases, key spots like this one. For example, here, back in October of 2024, look at this. Look at this, how this was looking like. We had this high time frame resistance range that got tested. And for those that do not remember what happened here, the mainstream sentiment was that no, we're headed lower, we're going to reject off of this resistance range. We have all of these bearish narratives in play. Election could lead to a sell the news event. It doesn't matter whether Trump gets elected, it is already priced in. You see here the market's already rallied, so we're gonna have this rejection and then maybe we can have a continuation. So I'm going to buy here at this pullback. This is how the mainstream sentiment was looking like. And very similar to this, we have another rejection, right, off of this high time frame resistance range. And people are currently saying pretty much the same thing. No, we're going to have a deeper correction. You know, as we'll cover in just a few minutes, we also have an interesting fractal that has been used with the 2021, and people saying that we're currently having a similar sweep of the highs to the one we've seen back in 2021. So if you look at what happened in 2021, we pretty much had a sweep of the highs that eventually led up to the bear market. And that's what people are talking about right now, having this sweep of the highs, and now they're saying that we could be entering a bear market. So we'll talk in just a few minutes about that as well. But this is how the market sentiment impacts the price action, and this is also how market makers are using these headlines in order to use retail as a counterparty in order to stay one step ahead of the mainstream media outlets. And this is also why the price always leads the narratives. The narratives will never lead the price, right? So if you think about what narratives mean, what these media outlets mean, what all the news mean. The news cover events that already happened. So the news cover events that already happened. Do you think that events that already happened will have an impact on the price action anymore? They won't, because they already happened. They already took place. They are already included in the price. So they're not going to have any impact on the price anymore. This is also how the efficient market thesis works. This is pretty much the foundational concept that is based on. I'm a big believer in the efficient market hypothesis, which says that information is included in the price, and the best way we can track all information is simply by looking at the price. This is also why I'm a big believer in technical analysis and how it works. So there are a lot of things to be discussed here, but the way I interpret this is that we could be having a very strong narratives. So we can predict narratives by the use of the price action. So I'm looking at this, I'm saying, okay, people are currently looking at this and saying that we're entering a bear market. So I'm not caring about that, I'm caring about the price action. How is the price action looking like? Is it looking bad? Well, we're currently consolidating right around this high time frame support range. So this is where we're consolidating. We can add also a couple of technical indicators. We have the bull market support band, which is currently going for a golden cross. Now we can use prior instances where the bull market support band went for a golden cross, and we have one instance back in October of 2024 and the other back in November of 2023. These were the only two instances where the bull market support band formed a bullish cross, a golden cross. So we have a bunch of indicators out there that are telling us that no, we're not entering a bear market, and that no, this isn't a distribution phase. Also talking about the distribution phase, as we'll cover in just a few minutes, altcoins and the performance of altcoins and the Bitcoin dominance is a very reliable way through which we can assess the broader market cycle and determine whether this is a distribution phase or just another reaccumulation spot that eventually precedes the next leg higher. So returning to what I was saying earlier, we have a ton of bullish conferences currently on the charts, and as we'll cover on the on-chain data as well. And we can correlate this to predict future narratives. This is why I cover the macro data in the first place. The macro data is a very reliable way through which we can predict upcoming narratives. And as we've seen a couple of days ago, the PCE year over year came in at 2.1%, just around Fed's target of 2%. So I'm thinking about this, that we have a very strong catalyst right around the corner we are currently at an inflection point from a technical standpoint, right? Because we're testing this high time frame support range. So we're having all of these confluences lined up perfectly, exactly like we had back in November here with the upcoming election of Trump. We have a very strong catalyst that is coming. We have a very strong narrative that could be used by media outlets to induce euphoria in the markets and to remain on the same side with the, with the mainstream sentiment, let's say. Because think about it. This is also what I said in this thread. Think of the headlines and how everyone will start believing in ideas like soft landing or QE is coming or super cycle. We're going much, much higher. Liquidity will finally enter the markets. Now is the time to be bullish, right? And think of it while the prices are going up. Think of it this way. So while the prices are going up, we have all of these positive things that are going on. We have maybe even narratives around Bitcoin, how a US strategic reserve will be further developed, how institutional adoption for Bitcoin will continue to grow, right? So we have all of these narratives and potential narratives and potential catalysts right now for Bitcoin. While retail is feeling uncertain and fearful and is still unsure of whether to buy or whether to wait for lower before we may be heading higher, or whether we're entering a bear market, right? So they are uncertain. Now we'll discuss about this in just a couple of minutes around a potential invalidation scenario I'm seeing right now. So the only invalidation scenario for this bullish thesis. But there are so many confluences that are pointing in the same direction of this emotional gap that will form and this final blow off top phase that will precede this distribution phase and later on bear market. There are so many things that are pointing towards this direction that I'm not even, I'm not considering any other scenario to be likely possible, right? So I'm not, but I'm still considering some potential invalidation scenarios because no matter how many confluences we analyze, we always want to have contingency plans. Okay, so this is the thread I shared a couple of days ago. This is my broader market view. This is how I see the markets moving forward. This is how I correlate all of the narratives, all of the macroeconomic data, all of the on-chain data, the charts, the technical standpoint, and so forth. This is the big picture that we're looking at. This emotional gap that will form. And once again, it all comes down to liquidity. This is something that you have to keep in mind whenever you're trading. So even if you're trading on low time frames, something you learn if you learn about, order flow or order blocks, how they work and so forth. Even if you're trading on the low time frames, it all comes down to liquidity. And if you're talking about high time frames, it all comes down to liquidity as well. So it all comes down to liquidity then. No matter the time frames for trading, no matter the time horizon you have, it all comes down to liquidity. So if there's something I've learned in the markets is to think about liquidity. Where liquidity is going to flow next, where liquidity is going to rotate, so which asset class depending on the risk appetite of investors, how is the macroeconomic environment impacts it, and so forth. So there are a bunch of confluences we can analyze, but it all comes down to liquidity. So moving to another post I shared back in late May, this is pretty much the max fuckery scenario for Bitcoin right now. And I highlighted it back in late May, so a couple of days ago, about 2 weeks ago, where I said that we're gonna have this crash in early June, followed by a very big bounce to the upside and new all-time highs. Now that we're looking at the charts, and this is the exact same fractal I shared, there is this support range and then there is this line I shared. So you see here it has played out pretty nicely, And now I'm expecting to see this big bounce to the upside on the low time frames. So in the next couple of days, I'm expecting this big bounce to the upside to flush all of the shorts that are currently in the markets. So market makers have flushed both longs and have flushed as well as and now they're starting to flush the shorts as well. This is why it is the max fuckery scenario, because both sides get wrecked. And that's the beautiful part about it, that both sides get wrecked. This is why I always say avoid leverage, reflect on the broader market picture whenever we have consolidation phases like this, because you never want to get trapped in the short-term noise. This is the max fuckery scenario, but if you would have followed me and you would have followed this pretty much fractal I shared, it would have definitely not been max fuckery for you, and it hasn't been for me. I have managed to get my hand on a bunch of spot holdings over the last couple of days while the prices have gone lower. If you'll remember, a couple of days ago I said that I would be risking, so I de-risked, and now I have DCA'd some of the profits I took back in to position myself for this bounce to the upside. So now I want us to have a look at the 2021 fractal. I feel like it's time for us to talk about the potential invalidation scenarios we may have moving forward, because we've discussed a lot about our main base case, what I believe right now to be true, what are the most confluences pointing towards, but we also have invalidation scenarios for this thesis. So it's time to address each one. The first one I've seen on X is the 2021 fractal, where a lot of people have highlighted that Bitcoin, as well as I covered earlier, Bitcoin has swept the prior high, formed a new all-time high, similar to what happened back in 2021. But if we look at total 3 is down over 20% from the highs. And you might wonder, well, how is this relevant in any way? Well, let me tell you this. The performance of altcoins shows us the risk appetite in the markets. How good altcoins perform is a direct indication on the risk appetite of investors. When altcoins perform good, that signals that there is a very high degree of risk appetite in the markets. When altcoins perform bad, however, and underperform Bitcoin, that signals that risk appetite still isn't sufficiently high for Bitcoin to enter a distribution phase. So think of it this way. Market makers need to distribute, okay? Market makers need to have a counterparty. Can they use the current retail investors as a counterparty to distribute? Is retail FOMOing in right now? This is what the performance of altcoins is showing us, whether retail is FOMOing in or not. Back in 2021, when we're looking at the total 3, which is highlighted in red, we see that the total 3 has formed a new high, as altcoins were outperforming Bitcoin because the risk appetite was very high. Therefore, market makers used that very elevated risk appetite of investors to distribute, as retail was FOMOing in once again. This time, however, we're seeing that the total 3 is still down over 20% from the highs in November, which says a lot, as it means that the risk appetite still isn't sufficiently high for market makers to start distributing, as retail isn't FOMOing in. So, can this be a distribution phase anymore? I don't think so. And this pretty much dismantles this whole 2021 fractal thing, because the altcoin market is saying the opposite. This isn't a distribution, it's still a reaccumulation phase that I believe precedes the next phase higher. Now also, something I want to highlight very shortly before we move on to our next invalidation scenario is the on-chain data. So the on-chain data is really important because it helps you to understand what happens behind the price action and what are the main drivers of the price. So looking at Bitcoin, yesterday, while everyone was watching the clash between Elon and Trump, the on-chain data was showing us that bears were doubling down on their shorts. So pretty much how this has worked like is the price has gone lower while the open interest went up, while funding rates went into negative territories. Now, the open interest, for those that do not know, the open interest shows us the total amount of perpetual positions. So both longs as well as shorts. Therefore, we cannot know which are so we cannot know where the most positions are, whether they are in favor of the shorts or in the favor of the longs. Most of the times the markets tend to go in the opposite way of where the most perpetual positions are. So if there are more longs, then the markets usually drop. If there are more shorts, then the markets usually go up. Right now we're seeing the open interest going up, signaling that there are more perpetual positions. But we cannot tell which one is it. Are there longs that are piling in? Are there shorts that are piling in? This is where funding rates come into play, because the funding rates shows us the ratio between longs and shorts. So whenever the funding rates going to negative territories, it signals that there are far more shorts than longs. And especially when we have durable drops like this one, when we see that the funding rates drop continuously and eventually enter negative territories, it usually signals that bears are actively doubling down on their short positions, which is very telling because it also correlates with the current market sentiment and how most people are currently feeling, which is the sentiment of uncertainty, of anxiety, and everyone calling for this 2021 fractal thing. So yeah, I think that the on-chain data is currently showing us that the most likely outcome moving on from here is to go up and to flush all of those longs, and this is where also this max fuckery scenario comes into play, where now it's time for the shorts to finally get squeezed after the longs have been successfully flushed. But now I want to cover the main invalidation scenario I'm seeing right now for Bitcoin, because as I highlighted earlier, there are two main scenarios that could invalidate my current bullish thesis. So there is the 2021 fractal, which I've dismantled, but also there is this one that I find likely to happen if certain bearish confluences play. This one relates to the Q3 weakness. So from a seasonality standpoint, the third quarter of the year is weaker for Bitcoin. So Bitcoin is weak in the third quarter of each year. So I've outlined every single third quarter. Back in 2024, we've seen this consolidation phase. So the price didn't really go anywhere. Back in 2023, we've seen this drop in Bitcoin's price. Now, of course, back in 2022, this was a bear market. 2021 and 2020 have been more bullish in the third quarter, but you might say that it was due to Fed's quantitative easing program and the Fed actively injecting liquidity in the financial system. This is why, some people may not consider this. And 2019, 2018 have been bearish as well. So as a bottom line, the third quarter is weaker from a seasonality standpoint, and it starts on July 1st and it ends on September 30th. This is what I've seen a lot of people currently worrying about, and I personally consider it as a possible outcome now. If I were to look at this chart, if this were to play out, I would consider this very similar to 2023, something similar to this. So the weakness in the third quarter will lead to a prolonged consolidation phase that would eventually precede this major move to the upside. The once again, I personally don't think this is likely to happen. A lot of people seem to be betting on this idea. This seems to be like the main consensus right now, that we're going to have a boring summer or something similar to what happened back in 2023. And once again, I've outlined why I don't think this would happen, due to the emotional gap that would occur moving forward if the price goes up. And if Bitcoin doesn't allow for sideliners to entry at these levels, that would be the pretty much the perfect scenario, right? Where market makers later on have liquidity to distribute at the top. Now, this is pretty much the only invalidation scenario I see possible for Bitcoin. So I've dismantled the 2021 fractal. I've shared why I don't think it's possible right now due to how low the risk appetite of investors currently is. So mainly what this is related to is whether we have a prolonged consolidation phase, something similar to this, due to the weakness in the third quarter, or whether we go up straight up from here. So something similar to this, which is my current base case. In no scenario do I think Bitcoin has topped out for this cycle. And the reason is, once again, the risk appetite. The risk appetite still isn't sufficiently high for market makers to distribute at these levels. And the Bitcoin dominance confirms us that. The performance of altcoins confirms us that. The upcoming narratives and the transition of monetary policies confirm us that. So there are a bunch of confluences that confirm us, right? We have the global liquidity that is also going up. So there are a bunch of confluences that tell us that we haven't topped out for this cycle. This is what I said back in early April, and this is what I stand by to this day. I do not think Bitcoin has topped out for this cycle until there is an actual distribution phase that leads to an alt season and to a crash in the Bitcoin dominance. Until that happens, we're still pretty much in safe territories when talking about cycle perspective. Right, so this all relates on whether we could see a prolonged consolidation phase similar to what we've seen in 2023 before we have this breakout, or whether we have this short-term pullback here, which eventually precedes the next impulse to the upside. By tracking the on-chain data and multiple technical confluences, I believe the most reasonable and the most likely outcome right now for Bitcoin is that my base case plays out. However, if certain bearish confluences play out, such as if we look at this, we have a very strong and reliable way through which we can understand this. So we've had, from an Elliott wave standpoint, this looks like a 1 to 5 impulse up to me, right? We had the first impulsive wave 1, then this consolidation phase as a corrective wave 2, then corrective wave 4, and this final impulsive wave 5. Now it looks like we're in our first major corrective wave 2. So how this would look like is that we've had this first impulse up, wave 1, followed by this corrective move, corrective wave 2, and then we have this impulsive wave 3, and later on wave 4 and wave 5. It would be very interesting because this would also fit really well into my blow off top and emotional gap thesis I've shared earlier. So from an Elliott wave standpoint, this would make a whole lot of sense, and it only acts as an additional confluence to my already existing thesis. But if we go below the bull market support band, so below $94,000, then we may be risking seeing a prolonged consolidation phase, as this risks not being just a corrective wave 2 anymore. So how this would look like is, if this corrective move goes below $94,000, it risks not being a corrective move anymore. And then later on we can see a prolonged consolidation phase, something similar to this, and later on to have this breakout. This is what we risk seeing if we break below $94,000. This is the main level I'm currently tracking. As long as we stay above it, I think that the base case is still intact and is still in play. If we go below it, then I think we risk seeing a prolonged consolidation phase, case in which my stance on the low time frames and on the midterm will shift to a more cautious approach. So these are my current thoughts on the latest macroeconomic data, the broader cycle, how it all fits into a big ball of, emotional gap and sentiments and liquidity, how market makers use it, the distribution that market makers will do in the coming months, how market makers have managed to accumulate over the past few weeks, and a lot of other interesting topics we've discussed in today's conference. So with that being said, this has been our weekly market talk, and I hope you guys have enjoyed it. If you did, please make sure to spread the word about what we do here, share the recording of this conference, and yeah, I'll see you guys in the next one. I hope you guys have an amazing weekend moving forward, and thank you all for joining today's conference.